How do I know if the market is going to continue or reverse? Is this a real breakout or just another stop run? Where's the high probability order block? Which way is the market going today? These are some of the most common questions that I get asked from my students. And they all have this one thing in common. They can be answered when you understand the dealing range. Before we dive into that, let me introduce myself real quick. My name is Ali Khan, and I've been trading algorithmic price action for almost 8 years now. I was privately mentored by ICT himself, and over the years I've been teaching these concepts to thousands of students all over the world. One thing I've noticed across the board is how overwhelmed traders feel with all of the information out there, especially when trying to apply it to their own strategy. That's why I created a framework called DRT, or Dealing Range Theory. I first introduced it last year during my 2024 mentorship, right here on this YouTube channel, and the response has been incredible. So I decided to break it down into a simpler, more digestible format for those of you still trying to find your way with ICT concepts and algorithmic price action. I promise you, if you've been struggling with consistency, this series is going to give you more than a few light bulb moments. So if that sounds like something you need, make sure to like, subscribe, and hit that notification bell thingy, because you really don't want to miss the gems I'll be dropping in this series. So let's get into it. So the first thing we need to focus on is what is a dealing range and how does a dealing range form? There are two main types of dealing range. We have a bearish dealing range, in which case we see price sweep an old high and then an old low. And we have a bullish dealing range, where we see price sweep an old low and then an old high. Now, this is specific to trending conditions, and I'll explain a little bit more of that in a minute. But first, let's discuss a bearish dealing range. Now, in this example, you can clearly see that we have a swing high here and we have a swing low below the market. But note how this price leg actually developed. We can clearly see that we've raided a swing high here. Then price has reversed and we've raided and closed below, which is also important, below the swing low that was formed to the left. Now, when we have the higher time frame dropping lower, so we're in higher time frame bearish conditions, and we see this new range form as this price swing moves lower, we can classify this as the dealing range high, since we have the highest high in that swing, which drops lower, and we have here is the dealing range low. So now we have the high and a low and a clearly defined dealing range. Let's just add a little bit more price action on this, and we can see how we ran higher, consolidated, and then we dropped one more time below that low. This is going to be our new dealing range, from the swing high down to the newly formed swing low. But for now, when we are inside of a bearish dealing range, we ideally want to see the market do two things. Not only do we want to see the market travel higher, we want to see it run above the midpoint of the dealing range high and the dealing range low. Above 50%, this is what we call our equilibrium line. So it's the equilibrium midpoint, or the fair price between the highest price and the lowest price inside of that dealing range. We refer to this as a dealing range because price is being dealt inside of this range. It will move from a discount into a premium market, and anything above this 50% line is going to be a premium price. Now, if we are going short, we want to sell inside of a premium market. As you can see, we raid the buy side here and we've rebalanced that inefficiency. And we can also see price has traveled into a premium. So this is an excellent place to take a short. Price then reverses lower and drops back below the dealing range low. Notice before it does that, it leaves all these equal lows. What's happening here is the algorithm is engineering sell side liquidity below these lows. This dealing range is known as a type 1 dealing range, and this is a continuation type dealing range. As you can see here, we now have a new dealing range low. Now let's call this a higher time frame. We can clearly see that the market is running lower. We can also see how it's raiding highs every time it drops lower. Again, raiding highs and dropping lower. This gives us a clear indication that the market is bearish. Now, I want to bring your attention to this piece of price action, and we're going to zoom in onto a lower time frame, like so. Again, we can clearly see here that we have a swing high. Below the market, we have a swing low, and right next to it, we have another swing low. This is extremely powerful as a signature because below those lows is going to be a big pool of sell-side liquidity. Remember, retail are looking at these lows as support since they look at that as a double bottom, and therefore they're placing all of their stops below that low. Of course, the algorithm has other ideas. It will reprice higher to the old high first. And remember, since the higher time frame is bearish, we're anticipating for a raid on old highs. Smart money, in this case, will pair all that liquidity above the old highs and distribute them lower to a pool of sell-side liquidity below the lows. Also worth noting in this example how we're seeing price contained inside of that sell-side imbalance that also closes below this near short-term low. Once we raid those equal lows with a close below that low, you see how we've had this displacement to the downside. Again, that is what we want to see occur in a bearish environment, right? Again, I'll get onto more detail about this in a future lesson. Since we now have swept an old high and an old low, and we have a bearish higher time frame, we now have a new dealing range high and a new dealing range low. So this would now be our new dealing range, and we would expect price to operate inside of this dealing range. Again, we're anticipating the same conditions to occur even on the lower time frame. We ideally want to see price travel above equilibrium, again, which is the midpoint between the highest price and the lowest price inside of that dealing range. And that happens. We can clearly see price runs higher into a premium market. It's worth noting that same fair value gap, that sell side imbalance that we previously outlined, you can see how we're finding resistance on that area. The bodies of the candles here are failing to close above the midpoint of that fair value gap. I have a teaching on the fair value gap leveling system on this YouTube channel, so it's worth checking that out. You'll understand more about what I mean. Since we have now repriced into a premium inside of a higher time frame bearish market environment, and price is rejecting from an area where we anticipate bearish order flow, we see the market turn around here and reprice lower to the relative equal lows that were engineered one more time before another drop to the downside. Now, let's talk about a bullish dealing range example. And again, this has to occur when we have higher time frame bullish conditions. I'm gonna get out of your way again. So here we have an example of a bullish dealing range. We have the higher time frame that is bullish, and we have seen the sweep of an old high. This marks our new dealing range high, and we have our dealing range low, making our new dealing range. In this case, since we have a bullish dealing range and the higher time frame is bullish, we want to see price drop below the equilibrium level into a discount market. So when we are bullish, we are buying inside of a discount market below equilibrium of the dealing range. In this example, we can clearly see that price has dropped into a discount and then it's ran higher. Now, something interesting happens here. We can see that the market starts consolidating inside of a fair value gap. Now, this is an indication that the market isn't yet ready to reprice higher. We further see the market reprice into a bearish order block. Price consolidates a little bit, goes back into the bearish order block, and then drops lower to seek the sell side liquidity, and this is inside of an extreme discount. Now, for the sake of this lecture, I'm going to keep it simple, but I'm going to get into extreme premium and extreme discount ranges in a later lesson during this series. But the same principles apply. The move inside of a bullish dealing range will occur inside of a discount. The main factor that we have here is time. Excuse the handwriting. But the main factor we have is time. And price is not going to leave the dealing range until the right timing mechanism kicks in. Again, we'll get into that at a later point. Once price drops back inside of the discount, we have these 3 consecutive down close candles over here that dig into a pool of liquidity to the left. This is our bullish order block. We can see how price reacts from this level and reprices higher to all the buy side liquidity engineered above these highs, and we have the relative equal highs still over here. So there's going to be a big pool of buy side liquidity. Smart money are going to take those accumulated longs down here using that retail liquidity, and it's going to offset those to the buy stops above these relative equal highs. Again, there's willing buyers above the market, right? They'll buy from the sellers and just sell right back to the buyers at a higher price. We can now see that we have another dealing range. We've raided the dealing range high and we've raided a no low, forming a new dealing range. I'm going to slide this to the left a little bit so we can get a little bit more detail over here. Of course, we have the new high and the new low. Again, midpoint is going to be the equilibrium of the dealing range. And again, we anticipate price to drop inside of a discount below equilibrium. In this case, it drops into an inversion fair value gap. There are so many things I can talk about on this chart alone, but again, let's keep it simple. We've seen price drop inside of a discount market, and then it reprices higher back above the dealing range high. This again is another type 1 DR continuation, where we're seeing the market continue higher inside of a trending higher time frame bullish environment. Let's go back to our original bullish dealing range before we got into the new dealing range. If we scrub this to the right, you can clearly see relative equal highs there. Again, we have our low resistance liquidity run signature, where we have this high being lower than the high to the left. In a bullish environment, we want to see the market reprice higher back to those equal highs. And down here, we had the reversal, which is why inside of this dealing range that we outlined before, we were expecting a type 1 dealing range continuation. Now, before we had this turning point, we had our dealing range high above the market, and this became our dealing range low as we turned around. This is another type of dealing range. We call this a type 2 dealing range, which is a reversal profile. Now, in the next lesson, we're going to get into type 2 dealing ranges and how we can identify reversals before they occur, and how that gives us directional bias on a lower time frame, where we can then use type 1 dealing ranges as a continuation mechanism and framework in relation to higher time frame order flow. Now, if you haven't done so already, below is a link to my free ebook, The Market Maker's Secrets. And that's going to be extremely beneficial for you to understand what I'm going to explain in the next lesson. So use that as a study guide, and I'm going to build on the teachings inside of that ebook right here on this YouTube channel. So I'll see you next time. It's so hard to do this.